Investors around the world have their eyes on the U.S. Federal Reserve Board today. The Fed is scheduled to make a rate announcement at 2 p.m. Eastern Time. And as always, we will bring you details of the announcement as soon as they are released, right here on BNN Bloomberg. Markets expect another hawkish pause from the Fed today. That is no rate hike, but language that makes it clear hikes are possible in the future if inflation proves stubborn. There'll be lots for investors to focus on. Jerome Powell, the chair of the Fed, will hold a news conference 30 minutes after the announcement is made. That news conference set for 2:30 p.m. Eastern Time. For insight, let's go to our featured guest of the morning. She's Brianne Gardner, Senior Wealth Advisor at Velocity Investment Partners, Raymond James. Thanks for coming in. Great to see you.
Yeah, thanks for having me, Paul.
Are investors getting more comfortable with the notion that these rate hikes are perhaps at their peak or certainly very, very close to their peak?
Yeah, I think in September, we are coming into a seasonal weak period for the stock market, and we saw Powell come out and, pass on that messaging of higher for longer rates. And I think that did kind of initially spook the market, then headed into the war kind of also in September, October. We have had a lot of turbulence within the market and the economy. So I think a lot of investors and us as money managers are really focused on the data that is coming out. A lot of what is moving the markets right now is data dependent. So the Fed has come out and said, next year they were going to cut rates potentially by 1%. Now they've shifted that narrative to 0.5. And so right now, analysts on the street are projecting that today there's still going to be 100% of no hike is what they're projecting. And so what we're really going to be watching is the narrative that does come out of the messaging today. Is there going to be a potential hike in the December meeting? Are they going to continue to hold rates? On average, we see both the Fed and Bank of Canada hold rates for about 7 to 8 months before they start cutting. So Canada, is continued on that holding pattern, and we expect Bank of Canada continue to be on that. But the Fed is a little bit of a different story because of the mortgage rates that we have in both Canada and the U.S.
Right. The last time Jerome Powell spoke, he said, quote, it may just be that rates haven't been high enough for long enough. That's pretty blunt talk. That is clearly feeding into the higher for longer narrative. That is a clear statement that the Fed sees higher rates for a longer period of time. Will that be the theme today as well? Is that something that you and other investors will be watching for?
Yeah, I think we would definitely have to agree. I think the Fed was a little bit late to the party, even on hiking, right? We saw Bank of Canada do hikes before the U.S. And so we also expect Canada to cut rates before the U.S. So for the Fed to come out and Powell to come out and say higher rates for longer, that does align with kind of the data dependent what is happening, what the narrative is for keeping those rates higher before a recession. So our expectations are still, potentially for the U.S. headed into Q1 and Q2 to see a mild recession, not a deep recession at all. But again, they need to keep these rates up to cool the economy and to cool the consumer, because the consumer is still hot in the U.S.
Right.
And that is pushing GDP. From the last GDP figures we got was showing the U.S. economy is still growing at a healthy amount, right?
Consumer's still hot and the job market is still hot, and those two things are tightly related. Of course, how much of a headwind is the strong job market in both Canada and the U.S. to central banks who want to cool inflation?
Yeah, we definitely see the job market as something that we're monitoring. I think we are starting to see signs of cracks from the consumer, though. You're seeing delinquencies increase. You're seeing, investors and consumers start to spend the capital that they did have coming out of COVID built up. They're depleting their cash reserves. You're also seeing increasing debt and increasing credit card loans. So all of that added up, you will start to see the consumer slow down. And in the U.S., the consumer drives 70% of GDP growth. So if the consumer is slowing, we will then start to see GDP come down. One
thing that's been noted recently is that credit card balances in the U.S. have recently crossed the $1 trillion threshold for the first time ever. Might that be an early sign of a slowing U.S. consumer? Yeah, we would definitely have to agree. And even with interest rates are where they are with credit cards, right? Anywhere between, I would say, 18 to 22, 23%. It's a lot different than those low interest rate environments that a lot of consumers were used to repaying these payments, especially borrowing money, leveraging their homes, borrowing lines of credit, some at 2 to 3%. Now you can't get a line of credit probably below 7%. And
And, again, the U.S. is different in that their mortgages are mainly locked into around 3.5%. So even though they have mortgage rates around 8 right now, in Canada, we're on those variable rates. So the U.S. has about 2% of mortgages renewing in the next year. That's very minimal compared to the Canadians, where we are a lot more leveraged, we are a lot more interest rate sensitive, and that does impact us as consumers and our spending.